typical webinars, 2 people sign up for every person who shows up. We're already over that ratio, so we'll probably smash the attendance record as well. We're kind of trying to figure out what drove all of that. We're very happy it happened. I think that the topic that we have today is probably as important as anything we've learned and discovered through all of our work in the last decade. I think it's a game changer for the industry. I think it's a game changer as we've tried to, as I think most folks on the webinar realize, we've tried like heck to help change and evolve the dialogue in the boardroom, so that we can get the board to focus on the things that truly matter. And I believe that this topic is central to that issue. So for the last year, we have been offering in a limited, controlled rollout a free service for the club industry, what we call the Strategic Monthly Dashboard, which we launched just about a year ago. Over the course of that year, we've had about 150 clubs participate in that controlled rollout, and we are opening it to every club in the industry now. And the whole purpose of this is to really do something that the industry sorely needs, and that is to understand the market in which we all compete as clubs. Our industry, as I think we all would agree, given its fragmented cottage nature, has been slow over the years to adopt and embrace technology and change, frankly. And we're trying to bring technology and data to the table so that we can make better business decisions in the boardroom and in the management team room. One of the things that we discovered by listening to all the clubs that we work with, give or take 1,000 clubs, is they love what we're doing with our annual data gathering. As I think most folks know, we pioneered an approach to data gathering that was negating or obviating self-entry, a way to gather financial data in a comprehensive and accurate manner and make it very easy for the participants. We've obviously pioneered that method. We've had it in place for over 8 years now, and it's a very well-honed, scalable process at club benchmarking, and it obviously allows us to talk to a lot of clubs about data. One of the things that we heard in those dialogues over the years is there's a sense that clubs would like to embrace data that's not just annual data. So obviously the rhythm in a club, I'd say the way I look at it is there's kind of 3 rhythms in a club. One is the daily rhythm, and the staff understands the daily rhythm, the management team and the staff. That revolves around the member using the club and the staff engaging with the member as they use the club. Another part of the rhythm is clearly the annual budgeting process and the annual book closing process, which is so, it ultimately is really the financial changes of a club. They really change year to year, not month to month. There's month to month variation in the club finances, but they're not significant, which is a whole other topic. The significant financial changes in a club occur year to year. But there was this sense, as we listened, that the board wanted to see data every month. So we kind of had a sense that would be a good thing as well. And we had already been talking at club benchmarking about what really does change month to month. And what became clear is what changes month to month, in fact, what changes constantly, is the market that we compete in. We track the fiscal year end of a club's closing. Clubs in this industry clubs close their fiscal year end in all 12 months of the year. Obviously, the most common year end closes December. The second most common year end closes September. But every single month of the year, some club closes their books and starts a new year. That means every single month of the year, some club is changing its dues, its cost of belonging, possibly its initiation fee. As we know, every single month, there's members entering clubs and exiting clubs. So the market in which we compete as clubs is dynamic. It changes constantly, yet there is no way to understand what's going on in the market. So the main impetus behind the strategic monthly dashboard was to allow clubs to precisely measure their trends against their local competitive market, let's call it their peer group, and the industry at large. And we've done that now. We've developed a platform. It embodies the very best and most scalable business intelligence software available in the world. The platform is based on Microsoft Power BI, Power Business Intelligence, and it's free. The only thing a club has to do to participate is submit data. And over time, we'll make that much easier. Frankly, we'll probably make it automatic as well. But in the meantime, it takes a club, and when we did the first test, not the 1 year limited rollout, but the true beta testing, one of the requirements we set for ourselves is that a club had to be able to submit the requested data with less than 20 minutes of work, and we've confirmed that with all the clubs that participate. What we'll end up doing, and we've done already once, and I think, frankly, it's behind the volume of people that are on this webinar, is we will produce a quarterly publication summarizing these trends and get it out to the membership. Initially, and the membership, the market. Initially, we've submitted that quarterly publication widely because we're trying to garner more participation. Over time, as we garner participation, we will only publicize that information for people who participate, clubs who participate, because obviously it's the law of the commons. You can't be a freeloader in the end. The only way this data exists is if clubs participate, and if they don't, it doesn't. The publication that we will publish, and the way we've organized the data in the platform, is there's three basic areas. There's membership, there's cost of belonging, and then there's high-level financial metrics, both operating and capital. So, as I said a moment ago, and we really have to embrace this. I just think it's so critical. And when I'm looking at the SMD, the Strategic Monthly Dashboard, it's funny. When we look at the annual data, I kind of look at it from my perch, doing what I do with our company. And when I look at the SMD, I much more look at that from my perch as a board member at my own club for 10 years. And I always felt that we didn't have any clue what was going on in our market. And I think that's true in every club for the most part. Now, there are certainly general managers and controllers, and there's certainly clubs that trade data on a regular basis using spreadsheets. But across the industry as a whole, there's very little what I'll call market intelligence in the club room, in the club boardroom, in the club management room. And we know by the nature of the market's constantly changing. This members continuously are constantly entering and exiting clubs. Member counts are constantly fluctuating. We have some great data on that today. The clubs are continuously raising and lowering the initiation fee, dues, and fees. I happened to be on the board of my club in the meltdown in 2007 and 8, and I'll tell you, it was white knuckle time, no question about it. And I know anyone that was involved in club governance, and I'm sure all the management, the great management, and I have such a heartfelt compassion for the management team and clubs. But we know, anyone involved, we know what was going on then. It was very difficult. Every month, our board meeting started with how many people left. And then the next question is how many entered. And the second answer was less than the one that we got first. And I think it's logical to assume that we're closer to the next recession than we are moved from the last one. All you got to do is look at the stock market fluctuations as a result of the coronavirus to get a sense of the fact that things don't just keep going up forever. But what happened in that meltdown, what we saw, and we were starting the company right around that period of time, strategizing how to start it and thinking about the market intensely. But what we saw and lingers to this day, 12 years later, frankly, is that so many clubs made such poor decisions during that meltdown. And I would suggest those decisions were made because there was no market intelligence available. So when you start to see exodus of members and when you start to see your member count declining, there might be a tendency to think, and we know clubs did it, that if we cut the initiation fee, we'll get more members. Well, it doesn't necessarily work if the market's the problem and not the club. It doesn't work if the club's the problem either. I'm not a fan of cutting initiation fees ever. But the whole point is we're trying to allow each club in the industry with a simple investment of 20 minutes a month to actually see strategic insight. And that strategic insight that comes from this platform truly allows clubs to separate their own trends from the market trends. That's the essence of strategy. I just finished reading a tremendous book on strategy written by a McKinsey team called Strategy Beyond the Hockey Stick. And they've proven, this is in public companies, but they proved quantitatively that about half of a company's outcome over time is related to the market or industry in which they compete, and half is related to their own strategic choices and decisions. I have no reason to believe that's not true in clubs. But right now, because there's a lack of market intelligence in the club industry, it's impossible for any club to segregate their own strategic decisions and choices and the effect that's having on their trends from those that the market's having on their trends. We believe passionately this platform that we've created and we're offering for free to the industry allows clubs to do that. It won't happen overnight. We've had clubs submit data for a couple of months and then say, this data doesn't mean anything to us. That's our problem. We haven't done a well enough job of enunciating how clubs can use this data. But trust me, this data will change the dialogue in any club. It's new data. We've been innovators. We continue to innovate. It's mission critical data. And it's in sync, as requested by clubs. This market insight is in sync with the monthly board meeting rhythm that exists in clubs. So we have the daily operational rhythm, we have the monthly board meeting rhythm, and we have the annual budgeting and closing of the books rhythm in clubs. We've solved the problem on the annual benchmarking, the annual data gathering. We solved that, and we solved it 8 years ago. This allows us to solve the monthly board meeting rhythm with strategic market insight. And, in some ways, frankly, one of the motivators for us as we thought this through and developed it was we want to prepare clubs to be able to see the changing market when the next recession comes, because it will come. And this market intelligence will change the way clubs feel about it. It's the difference between flying with an instrument panel and flying in the fog. It's a big difference.
Ray, we had one quick question, which is,
sure.
How is the data anonymized so one club can't decipher competitors' data?
All of the data is everything we've done is aggregated, and we control the peer groups, and we will not allow a peer group to exist that is too small, meaning there would be some way for someone to decipher one particular club's data. So everything is aggregated and everything is measured to assure they can't see a specific club's data, which we've accomplished for the last 10 years successfully, and we think we've done the same exact thing again. Thank you for the question. This map is indicating the 150 clubs that have been involved in the controlled rollout. We put great pains into the process, and you can see pretty what I'll call robust geographic dispersion. It was done intentionally. We intentionally sought clubs for the rollout that we think represent a real cross-section of the industry. So we have small clubs and large clubs. We have a proportion of clubs without golf and with golf that match the industry at large. We have residential community clubs and standalone clubs. We have clubs in geographic areas that essentially match the distribution of clubs across the country. So you'll notice there's a bunch of dots in Florida. That's because there's a high proportion of the overall market in Florida. And you'll notice a bunch of clubs on the West Coast, same reason. But when you look at it, it's pretty easy to see that there's, blotches where there's a club dense area, but it's also easy to see. You actually haven't counted all the states, but you can see that most of the states have somebody participating. It's true on scale, revenue. It's true on quality of club. It's true on cost of belonging. It's true on type of club. So we believe that at this point, we've generated a cross-section that truly represents the industry at large. Chris Davis, who's been driving this project on our end, and I are both going to take part in this webinar. So he's going to lead us through the next few slides, and then I'll be back with you in a minute.
Yeah, thank you, Ray. This is a look at all the participants when you sign up to participate in the dashboard. Ideally, you are in a defined peer group. That's the middle column we're looking at. What that does is you've got half a dozen clubs in your geographic market that you want to compare to. Now, a couple of these started organically. There was a group of clubs out in Chicago that wanted to start a peer group, and it's going gangbusters there. They're the test markets that we did. We started this project a couple of years ago in Naples, Florida. Then we opened it up to Denver, Colorado, Hilton Head, and we also have a peer group, defined peer group with yacht clubs. Lacking a defined peer group, the box on the left is regional peer groups. We sort these regionally, either by chapter or geographic region. There's no limit to the amount of peer groups you can belong to. So, for instance, the Hilton Head clubs are also in the Southeast region, or Mid-Atlantic, rather. Work in progress, the box on the right, we're actively working with clubs to gain enough clubs, like Ray alluded to. We need a minimum of 5 or 6 clubs to start a defined peer group. So we're working in those markets to move forward. The biggest advantage when you're comparing your monthly reports in the membership report, when you have a defined peer group, you've got a built-in market share that you can see from month to month, which we've had a lot of board of directors take a lot of interest in that, rightfully so. We'll see that toward the end. We'll show you a screenshot. Next slide, we're looking at average membership counts. The data is showing, we've broken it down right now into 3 of our industry subsets, that being residential community clubs in the blue, standalone clubs with golf, meaning they do not have a residential community component to them, and then clubs without golf. So Q2 2019 to Q4 2019, this is the period of time where the dashboard was rolled out to the whole industry, and there's a fairly robust data set for these segments. As we move forward and gain participation, we will be able to break out the additional industry segments such as city clubs and yacht clubs. But right now, there's quite frankly just not enough data to have a meaningful analysis. Now, the point on the right is this data is showing that 25% of all clubs in the industry have a wait list. This is contrary to what was popularly believed in the industry, much lower number. This is what our data is showing, which is pretty groundbreaking. That, can you imagine that for years no one in the industry has really known what that number is, and now we have the data to support that.
Okay, Chris, thanks. Yeah, so I'm just going to emphasize that. If in all the, I mean, everyone on this webinar goes to education, participates in webinars, listens to industry pundits. The conventional wisdom in the industry is that less than 10% of the clubs in the industry have a wait list. I've seen very precise measures, some measures that have a decimal point after them, which I don't know how you get enough data to be that accurate, but I kind of had a sense that I thought, if you asked me going into this, that maybe that was true, but that's why we have data. Data combats conventional wisdom, and I'm pretty convinced, and Chris and I have scrutinized and scrubbed this data and really studied it. I'm convinced that the wait list, the percentage of clubs that have a wait list, is much closer to 25 than it is to 10 or under 10. I'm convinced of that from this data. And there's some other data which we'll unveil that kind of supports that. So one of the things that we measure, as we just saw, is membership count. When a club begins participating in this process, what we do is we ask them to give us a few metrics for the month that just closed and for that same month in the previous year. So while we've been doing this for a year, we actually have 2 years worth of data. So we have data that goes from January of 2018 through December of 2019, and we're just about to close out January of 20. And so when you look at this data over that 2-year period, it's very interesting. This is to me, is why I love what I do, but it allowed us to look at fluctuations of member count across 143 clubs. 150 or so are participating, but 7 or so didn't give us every single month for the 2-year period. But over 143 clubs over the 2-year period from 2018 through 2019. What we're looking at here is if you take the average member count for each club over that 2-year period, and then you take the minimum member count and the maximum member count over that 2-year period, and you say, define what the fluctuation between the minimum and the maximum is, and then say what percentage of the average member count is that over that period of time. This shows the percentage variation. So the median is 5%, which very much supports data we've been gathering for 10 years now, that the membership churn in the average club is about 5%, so it supports that. But when you look at this chart, you can see a quarter of the industry has had a membership count fluctuation over a 2-year period that varies at 8% or more. And a quarter of the industry has a membership variation that varies at 2% or less, a quarter of the sample. And there's probably about 10% of the sample had no membership count fluctuation whatsoever. So right there, you got the minimum of 10%. Those are clubs that literally a member comes in and a member goes out, and a member comes in the same month. There's no games there. There's no fooling around. They've had the same membership count for 2 years consistently, which is fascinating in and of itself. But look to the right on the opposite, clubs with a 15%, 20% membership count variation. So when you look at the initiation fee, the first two groupings, you can see that it's well over the industry median, which is between $25,000 and $30,000. On the right, you can see that it's lower. And so as we gather more participation, more data, what we'll probably see, same story is, there's much more consistency in member count in clubs with a high initiation fee, and there's much more fluctuation of member counts over time in clubs with lower initiation fees. The minimum variation, as I said, was 0%. The maximum variation was 21%. And the point being that the variation is higher in clubs with lower fees. And
Ray,
then
would you
here's
like
some
to do a
interesting.
couple quick questions for me? We've got
Yes,
a few
please.
rolling in. Okay. Is the membership count actual members or member equivalents?
Actual member count. Membership count.
Okay.
And that's a great question.
Is the waitlist data broken down by category?
No, we ask, the question is, does the club have a wait list, yes or no? And then if it has a wait list, how many members are on it? We don't ask by category. Good point, though, to whoever that question came from.
Okay, next question. How do clubs establish a wait list? Is it a fixed number or how busy the first tee is on a Saturday morning?
I think that clubs that have a wait list, I would suggest, and we haven't asked this, to be clear, we don't ask this in the data gathering, but based on all the data we've looked at and my experience, my suggestion would be most clubs do have a cap in a category or in each category, and the clubs with a wait list are at the cap for the given categories. So they literally have no room for people, so people line up to get in the club based on the cap.
Okay, next question. Do you use home sales in residential clubs?
That's another great question. We have a person on our team whose name is Mike Timmerman. He's been with us for a little over a year now, and he is a counselor of real estate, meaning he knows a lot about real estate valuations and real estate sales, and we are aggregating such data into our database for residential community clubs. It's not a production service, if you will, at the moment, but we have definitely done that with probably about 20 to 30 residential community clubs now on some initial basis. So that's our vision, though, is that we will also measure that in residential community clubs in time.
Okay, why is $57,000 initiation fee not on the far left as opposed to the $44,000? Actually, it's a great question. There's a couple of points there. I know pretty much every club that we've been working with in this controlled rollout. There are a handful of clubs in that second quartile with the initiation fee of $57,000 that I noticed had pretty significant assessments last year, and
loosened up a bunch of members, so they had a lot of members leave, and it took a few months to fill it back up. But I can't say that's definitively at the root of it, but I know that's a factor in it. And then I would also say that in general, when you're looking at that whole spectrum, you're looking across the industry, and there's great variation, which I'm going to show on the next slide. There's great variation in the initiation fee across the industry. So when you look in the lower quartile, and to be clear, on the right here, this is off of our annual data gathering. I used it as a way to make some points relative to the strategic monthly dashboard. But you can see in the lower quartile, a quarter of the clubs have an initiation fee of $7,500 or less, and a quarter at 60 or so or more. And part of what we're seeing there is just the mix. I'm sorry, I went the wrong way. The mix that there's some clubs on the threshold of this, quartile breakdown that we do that have high initiation fees. I literally drew the quartile breakpoints at the quartile, and you might have. I didn't use a tenth of a decimal point. I'm getting very technical here. I was only using one digit. So there's if you look at 2% variation in membership count, there's probably about 8 clubs that had a 2% variation. I drew the line between club number 1 and club number 2. Club number 2 had an initiation fee of $150,000. Club number 1 had an initiation fee of $60,000. So there's some data kind of anomalies like that. But I think as we gather more participation, what you'll see is a consistent trend, as the questioner would deduce, a consistent trend with it. The membership count fluctuation varies higher. You're going to see a trend in initiation fee downward, as you kind of see when you look across the whole spectrum.
Okay, we've got a lot here. On the left are those clubs where you have a stock buy-in.
We have what?
A stock buy-in.
That's a very good question. Actually, we could answer that. I can't answer it right now because we didn't do that research. I will say, in the end, as we all probably know, one of the trends, macro trends that exists in the industry now is away from equity in your initiation fee. Clubs are tending to get away from that, and when a member writes the check to come in, the check's gone and they don't have a share. Generally speaking, that's a trend in the industry.
Okay, these other questions are related to, they're all related to the question about the 44 versus the 57. So we're going to let Ray keep moving, and then all the questions I have recorded here, and we will make sure that we follow up with each of you. So if we don't get to you live, we'll follow up by email.
Okay, thank you. And keep them coming, too, if you have them. This is real interesting data. Again, I would suggest respectfully, groundbreaking data. I don't think the industry's ever seen this now to this point. But here we go we can look at the initiation fee based on whether the club has a wait list or doesn't have a wait list. Look at the difference in clubs with golf. If it has a wait list, the initiation fee at the median is $68,000. That's at the median. And if it doesn't have a wait list, it's $20,000. Without golf, $13,250 overall. With a wait list, $18,500. Without a wait list, $10,000. And the distribution on the right is just from our data gathered for 2019. We've already gathered, by the way, I think we're into the 600 club range of data that we have in our database right now for 2019. So that comes out of that, and I didn't filter it for clubs with golf or without golf. It's both types. But you can kind of see the very clear relationship between the data in the SMD and the data that exists in last year's annual data gathering. The point is this, and can't emphasize this enough, and it goes right back to the point of the SMD and what we're trying to do in getting the right dialogue into the boardroom of the club. The point is that the whole
strategy in a club is to have a value proposition that's compelling, so compelling that we have people lined up outside to get in the club. And if we do that, by definition, the initiation fee will increase as shown in this table. And that means we have access to more capital, which allows us to keep reinvesting. And the clubs that have choked the initiation fee because they have a value problem have a harder time aggregating the capital to reinvest. There is really a momentum cycle in clubs. We're kind of going one way or the other. And it's all about the value proposition, and it's not all about the costs of how much it costs to belong. The clubs with the highest dues have the highest initiation fees, and the club with the lowest dues have the lowest initiation fees. We have to get that message across to the board, and we have to do it every time the board meets, which means every month. And we have that data being aggregated every month now. And Chris is going to take us through some cost of belonging data.
That's right. Here's the clubs without golf industry segment. Cost of belonging overall is $63.58, and that is the full family dues rate, the highest level of membership with access to all amenities that we track on the data collection sheets. That is broken down by operating dues of $41.77, capital fees of $12.48, and all other mandatory fees. That's things like bag storage fees, locker fees. That's $934, and that is, to be clear, that's only if they're mandatory, not if they're optional.
And if I just may add to that, this is clubs without golf, so it's
Correct.
It's unspent minimum and level service fees, things like that.
Right. Right.
One thing I just also make a point, please. The capital fees, the way we gather the data, because we had to make some decisions. If a club has, we can segregate it, to be clear. We have detailed data underneath this. Obviously, we can't show everything in an hour, but we do ask clubs if they have recurring capital dues, if they have a debt service fee, or if they had a capital assessment. And across the entire data set, all the clubs participating, that average includes all three of those: capital assessments, recurring capital dues, and debt service assessments.
Correct. Here is standalone clubs with golf industry segment. The total is $10,188 per year, broken down into $76.93 in operating dues, $1,083 capital fees, and $1,413 in other mandatory fees. Residential community clubs, also known as gated communities, with a real estate component to them. Total cost of belonging $14,562. Operating dues of $10,977. Capital of $1,854. Other mandatory fees of $1,731.
Good.
That's it.
Okay. There's data there that is updated every month. So all that cost of belonging data will capture real-time market changes for any club that participates. Something else we learned. So I think that we've shown three things, I believe, this afternoon or this morning, if we're on the West Coast, that I would consider to be first-time information for the club industry. This is now another one. We asked the question, does the club allow for financing of the initiation fee? 54% of the clubs have said yes to that question. We next ask, if you allow financing of the initiation fee, what is your term? And we've bucketed it. They can put in the number of years. We've just bucketed the data into the different possible categories. So 60% of the clubs, which would ultimately be about 33% of all clubs that allow for initiation fee financing, allow for financing between 1 and 3 years. 31% between 4 and 6, 4% between 7 and 9, and 6% 10 or more years, which is really fascinating. Talk about making it easy to join the club. There's some rounding there. We didn't put the 1 decimal point, so you can see that adds up to just over 100, and 100% is 101. It's only because we didn't use the decimal points. Asking question in real time of Chris. Do we also ask the rate? We don't. We decided not to. So this is, if anyone's in the boardroom and having this discussion, which I would suggest is a strategic consideration, whether you allow the initiation fee for finance or not, here's some data that you could access that would allow you to have a data-driven discussion on that topic. And now Chris will take us through the next 2 slides.
This is the,
What do you want me to do?
we looked at non-dues revenue and net available capital. Generally speaking, non-dues revenue is an indicator of membership activity, and net available capital, as a reminder, it's net from operations plus capital income, subtract lease payments. That's the amount of capital available for capital investment in the club to grow net worth. So logic would dictate that clubs that consistently keep up with capital repair and replacement of assets will remain an attractive place for membership activity. But consistent with our fact-based approach, we prove that out through the data here. The approach we took is we looked at the time period of March through August 2018 versus 2019, called that as summer season. We analyzed the clubs with the highest non-dues revenue trends, year-over-year change, and with the lowest increase or decrease. We compared the non-dues revenue trends with the net available capital ratios to determine if that relationship exists. Clubs in the upper quartile of net available capital had a 16% year-over-year growth in non-dues revenue at the median. That's the middle 2 bars I'm looking at now. And the net available capital, which we consider a minimum of 20% net available capital ratio of 20% to be capital rich. That's what, at the median, those clubs turned out to be. Clubs in the lower quartile experienced a year-over-year decline in non-dues revenue, so there was less activity than the year before. And those are borderline on the capital starved. Anything under 10%, we generally consider a capital starved club. The industry median, which is the 2 left columns, is 13% for net available capital and 3.6%. So what this is showing is that clubs investing more capital are seeing the greater increase of year-over-year non-dues revenue, indication of more member activity, and the clubs lacking that capital actually saw a decrease in non-dues revenue. The conclusion that we're making here, based on this data, is that the members' capital investment is the key to sustainable financial success by increasing your net worth of clubs over time.
I'm just going to build on that and just re-emphasize it. So what Chris just said, just to be clear, the clubs with with capital in the lower quartile in the industry actually saw, between 2019 and 2018, a decrease in non-dues revenue, indicative of less activity by members. And the clubs that are in the upper quartile with net available capital, meaning the clubs that invest the most, saw an amazingly robust increase in non-dues revenue activity over the same period of time. The point is, and this is another, I'm going to put this in the 4th bucket of groundbreaking research.
that's critical for boards to see. We get questions constantly. We're looking at it from different angles now. If we invest, will they come? This slide says if we invest, they will show up. And it's not on the margin. It's, let's say mission-changing differences. Shrinking activity versus activity that's growing rapidly. Critical point. Okay.
This is some logistics of what you see as a participant. This is the main screen of our annual platform, but you see the link to monthly dashboard. That's how you get to the monthly dashboard for current participants as well as any of our annual subscribers. Everyone has access to this. That is how you get it. If you click on that and you're not currently subscribing or participating in the monthly dashboard, you'll be directed to the page where you can learn more about it, and we hope eventually sign up and participate. This is when you click on that link as a participant. Had some feedback of users. I just wanted to go over that if it's not clear. There is a user guide, which is the top right green box that explains all this, but usually helps to give a visual. Unlike our annual platform, these are essentially filters that I have circled there. Select peer group there's a drop down that you can participate in as many peer groups. There's no limit. When you choose a peer group, every measure, which is the boxes down below under One Fine Country Club, everywhere it says peer group, that is controlled by that filter of select peer group, and vice versa. The industry segment is along there. You see the 7 industry segments. Everywhere you see in the measures down below, industry is controlled by that selection. So for instance, if you're in this current peer group and you want to look at all clubs, that's what's currently selected, highlighted in green. If you want to look at, if you're a residential community club, you want to be compared to the industry of residential community clubs, that's where you toggle over on that. As I mentioned before, the defined peer group is a powerful thing when you're looking in your local market. If you have, say, half a dozen clubs or 10 clubs, that is your quote unquote competition. The middle box there where it says member count as the percentage of peer group, that defines your market share. So this club has 15% market share in its market of 7 clubs, where you see the peer group is 7 of 7 clubs. So that's pretty powerful. We've had feedback from a lot of board of directors that now track that every month, which is we're driving the discussion toward more strategic issues, which is one of the main points of doing this initiative.
Excellent. So I'll wrap up. We're trying to do 2 things here. We've shown some trends that are real time that we believe are illuminating and groundbreaking. And we want to make sure that everyone on this record-breaking webinar, literally, the number of people on it, and you're all still here, that you realize this platform exists that allows every club to see the market in real time. In what industry do we not understand our market? We're one of the few industries in the industrial world that doesn't have a mechanism to truly understand its market, what we'll call market intelligence, as opposed to business intelligence. That exists now. All it takes is participation. And in my view of the world, understanding the market in which a business competes is the essence of business and strategy. We believe, and we've had feedback from the clubs that are participating, that mission critical metrics that would be covered in that market analysis are member counts, cost of belonging in our club's market position relative to, as Chris said, our local competitors in the industry at large. We can now do that and see our competitive positioning, our market share with accurate data in real time.
And, I'm not trying to be pessimistic. I'm a natural optimist. But we do need to consider when the next recession comes, we kind of forget what it was like. I think it's human nature during the last meltdown. It would be much better if we had a dashboard that allows us to understand what's going on in the market so we don't attribute what we think is our club issue when it's really a market issue. And as I said at the outset in the book that I mentioned, I just read, if the club industry follows the industrial spectrum that McKinsey studied, half the changes in a particular business are related to the market and half are related to their own strategic choices and decisions. We sure as heck better understand the half that relates to the market, and that's exactly what we're trying to do. And I think we have a few minutes left. If there are any more questions, I will, I'll make a plea or a pitch, because we're trying to get from 150 clubs involved in this to 1,000. So we have over 500 clubs, or at least over 500 people who are registered for this webinar. That's a big step in that direction. If we can get everyone on this webinar to do it, we're going to all learn a lot for a little. It's free. It just takes 20 minutes a month. And with that, Terry, do we have any questions?
Hey, okay, if you can flip to that last slide, there's a web address there that you can go to get information and that sign up form Chris mentioned. I'm going to start at the bottom. Do you have demographic data on club membership? What can you say about millennials relative to private clubs?
It's not in this, it's not the demographic data that we do have is not in the strategic monthly dashboard, but we do have demographic data in our annual data gathering platform. Yes. And what I can say about demographics off the top of my head is that the median, it's a kind of a little weird to say this, but it's what it is. The median average age, if you take the average age of your club, and we've got it from hundreds of clubs, and you say, what's the median average age? It's 58 or 9 years old right now. And when we started this 10 years ago, the median average age was 58 or 9. It hasn't changed in 10 years, which means that the profile of the club to this point is similar to what it was 10 years ago.
Okay, what data are participating clubs required to provide monthly?
It's about 15 metrics, and the metrics, if literally, would be at the fingertips of anyone participating or anyone submitting the data. It's the cost of belonging data, operating dues, capital dues, debt service fee, capital assessments that occurred that year, level service fees, minimum spend, as Chris said earlier, locker fees, bag storage fees, anything that's mandatory. That's a bulk of the data. It's the total dues revenue for the month and the total non-dues revenue, the total in capital investment, the total debt at the end of the month, and then the member counts, the total member count, and the members entering and the members leaving. And you do it in the first year for 2 years. You got to do it for the month that closed and the previous year's month so we can get the year-over-year trend. It's literally data that exists at your fingertips. I think I just cited all of them.
Yeah. Question, and in fact, in the follow-up email, I'll send a copy of the worksheet, but also if you go to that clubbenchmarking.com/monthly, and sign up, Chris can get you that page. If you're an existing subscriber and you go log into the platform, you'll see the monthly dashboard button, and inside of there, you'll get access to the worksheets that you need. Is there a peer group for seasonal clubs?
That's a great question, and something we could potentially do. We don't have it right now. We'll definitely take that under advisement. If you're in an area where there are other seasonal clubs,
one area that clearly comes to mind in my own mind is the North Carolina mountains. There's a number of clubs that are pretty much 6-month clubs up there. But if you're in an area like that, it would be easy to, with the managers and controllers, to assemble a peer group that would represent that region. There's probably some in up in the Michigan Peninsula, in the lakes, and also in Florida, where we do have established peer groups as well. So it's a great suggestion, and it's something we could do, and we could actually make an industry subset seasonal clubs and define that. I would suggest the definition is clubs that have, variation in 6 months versus another 6 months of the year, that variation in revenue that is outside some range. Good question, good suggestion. We'll think about it. Is that it, Terry?
Oh, sorry, I was still muted. Several people asked about the formula or the calculation for net available capital.
Yeah, I'll tell you what, we will disseminate that to everyone who was on the webinar.
Okay. A number of questions around financing initiation fees. Several people asked about getting a copy of the slide deck. We are recording the webinar, and a link to that video will be distributed to everybody who registered. Ray, are we distributing the PDF of the presentation or not?
We will distribute it to the person who's asking, for sure.
Okay, great. Question, does the club do the financing of initiation fees, or is that done through an outside institution?
I know of a club that does it through an outside institution, but that A is literal. I know of one club that does that. I would say everyone else is financing it at the club level.
Okay, clubs that do it themselves, do they charge interest or fees for financing?
It's a question that we decided not to ask, but I would say that anecdotally and with experience, and I've discussed it with a number of clubs, I would say that some modest level of interest is more common than no interest. And by modest, I would say now that's like the 3%, 4% range.
I'm getting a little distracted here because I have about a dozen signups for participation coming in as we speak. That's awesome.
Beautiful.
Couple more around financing. Is there a correlation between clubs that are offering financing and their initiation fee, the level of their initiation fee?
That's a good question. We don't know. We could actually look at that. That's a great question, and we will look at that. And if you keep that person's name, we'll answer. And the way I would think it would, I think the question would mean, and it's a great thought, that clubs with lower initiation fees are probably more likely to offer financing than clubs with a wait list and a higher initiation fee. We can look into that. Absolutely.
Somebody just sent you a mic drop, Ray. So on that note, we have questions streaming in. So I'm going to leave the session open, but we'll end here. That means that we'll have those questions typed in, and we'll be able to respond to you by email as quickly as we can after this is over. So we thank you all for joining us today. It's been a great session.
And I just have to ask, well, there's still some people here, Terry. I know we broke the record or smashed the record for registrations. Did we smash the record for attendance?
Somewhere just south of 340 people on the session.
That's tremendous. So that's a record.
Phenomenal, yeah.
Well, thank you, everyone. thank you everyone for participating. This is one of those deals where if we all do it, everyone wins. It really, really is. It's going to change the dialogue, which we so passionately desire to do with you. Thank you.
Okay,
you.
thank you.
Thank you.
Thank you.
Curveball.
Ray, I'm leaving the session running so that we can keep catching questions, but if you